Well, should we move on and talk markets more? We'll bring in Martin Crabb. He's from Shaw and Partners, joining us live in the studio here in Barangaroo. Martin, pleasure to have you today.
Good to be here, Ingrid.
Talk us through what you're watching on markets today, because, as I said, we're certainly off the lows of the day and certainly haven't fared perhaps as poorly as Wall Street did overnight. It's still been a pretty negative day.
Yeah, well, better than feared. I think the SPY was down 57 or 60 points or something at one stage overnight. And obviously the sell-off was very dramatic in Europe. It continued in the US trading day, but they had that bounce in the last hour of trading. Had they closed at 3 and not 4, it would have been a different story. But I think we've probably closed down half of what the futures were predicting, and quite a few standout stocks. So the tech stocks, in particular, the WAC stocks, were all up today. They were when I left the office. So you wouldn't expect that. You expect the big sell-off in Wall Street to flow through to those tech stocks, but maybe they've done enough. They've all come back. I mean, Afterpay is probably close to 20% off its high. So I think a bit of resilience in that tech sector was a bit of a standout. But the flip side is all the commodity stocks got belted today. So we saw the energy stocks and the gold stocks all getting knocked around. Iron ore was off 4% overnight as well. So that sector of the market, which has potentially been leading us a little bit, started to give up a bit of ground.
Martin, I've got to get your thoughts on financials. Now, when we're looking across in Europe and the United States, it's undoubted that the fiscal struggles there are real. The health side of things is certainly worse than what we're dealing with here. But here in Australia, we're doing far better, at least for the time being, and hopefully it continues. Yeah. But the financials continue to get belted.
Yeah.
What's going there? What's going to go and snap this nexus where we follow what's going overseas and helps you see the financials start to recover again?
Yeah, it's the $64 question, isn't it? They don't seem to get a break though. I mean, as soon as they start looking like they're okay, there's some revelation about years and years and years of anti-money laundering issues that never got reported, worth $2 trillion. So it's like, people tend to trade these things on a global basis. So you see Wall Street banks like JP Morgan, Wells Fargo, Bank of America get sold off, the Aussie banks do too, even though they're for totally unrelated reasons. So I think there's a little bit of that going on, but I think it's that value growth thing. So all the consultants are out there saying, look, growth's overdone, it's time to rotate to value, but investors just aren't doing that. Today's a classic example. No one was buying value. There's heaps of value in the market if you look for it, but they just want to chase growth. And so what do? Sell banks, buy growth stocks.
Yeah, seems exactly like back to the dark days of the worst of the pandemic, where you just had healthcare, tech stocks flying, and everything else weaker again.
Yeah.
It's that rotation sort of taking place again.
Yeah.
Miners, though, and I know you guys at Shaw and Partners are keen on miners. What do you think right now, given the fact they've been coming off a bit?
Yeah.
There's obviously still upside, to come. We know the China story with iron ore. Yes, iron ore's taken a bit of a hit of late. What's your take on that? Do you add to positions at these levels?
We've been saying to fade the rally in iron ore, so we think $130 a tonne's unsustainable. It's down below 120 now. That's going lower. It will cross the oil price next year. That's our big call, right? So oil's at 40 and iron ore's 120. So which stock do you want to be in? So we're saying fade that rally. So in our model portfolio, we don't own any Rio, we don't own any Fortescue. We used to own Fortescue, we sold out of that. We've just got BHP. We're now looking at BHP saying, do we need to own that because it's got lots of iron ore? And we've been probably too early on energy. Probably the best thing to do is sell iron ore and buy anything else except energy. But we just think if those prices cross next year at 70 or 80 or something like that, we want to be in Beach, we want to be in Woodside, we want to be in Santos and those sorts of stocks. So yes, we like resources, but we don't like all resources. I think things like met coal and gold look really attractive. Iron ore, we're just saying, no, you don't need to be there.
I know that you previously liked gold. Gold miners have been caught up in the sell-off, and gold, surprisingly overnight, was also hit pretty hard despite a decline in real yields. Still like the sector?
Yeah, we still love gold. So it's bouncing around and it got overbought. We're just on the thesis that it's about negative real interest rates. It's not about inflation. It's about negative real interest rates, and it's clear from what everyone's saying that real rates are going to stay negative for maybe a couple of years. And that is an environment where you want to own gold. Think of it as a currency rather than a commodity. So it's basically a zero yielding currency. So we just think in a situation where every other bond market in the world is giving you negative real yields, own some gold. So we see going to maybe $2,500 an ounce. And again, that's based on that commodity call. You've got to be in the sector. Yes, you can be nimble and trade it, and some people are very adept at that. We just have the view that we'll just buy the high quality companies. So we'll buy the Saracens, Northern Stars in the growth side, and Newcrest for a broad exposure.
It's interesting because looking at small caps versus large caps, there's been a bit of divergence in performance. What have you made of that? And is that a trend that you expect to continue as we come out of this crisis?
Yeah, it's really interesting. I came across this stat on the US market, the fact that small caps had outperformed large caps there, which you think, well, hang on, Apple, Tesla, all those stocks. In Australia, it's been really dramatic. So that's just a chart of the of the ASX small ordinaries and the ASX S&P 100 indexed to 1 at the end of last year. So you can see they all got belted. They were down 35%, but small caps have actually come out of this better than large caps. You can see large caps are rolling over. If you actually look at one divided by the other, you can see that small caps have outperformed large caps by about 20%, which is quite dramatic. I mean, I wouldn't have thought that was the case. So you kind of scratch your head and go, why is that the case? First argument is that it's the structure of the small cap industry. It's got lots of resources are running, gold stocks, etc. So that's quite powerful. The other thing is small caps are more nimble and better able to adapt to the new environment than big caps. So I think banks, real estate, they can't really do much, right? They've just got to keep doing what they're doing. Whereas small companies, and think about companies that have got an online business model or they're in the technology space, so the buy now, pay later guys have grown up out of small caps into large caps. So I think in this environment where there's a lot of uncertainty and a lot of winners and losers, small and more nimble companies are doing better. So that explains some of the 20%.
You don't think it's Robinhood traders, new traders entering the market, retail
No,
investors?
because we look at valuations as well. Small caps are a bit of PE premium to large caps, but not overly so. So it's not like everyone's just bid small caps up through the roof and large caps are underdone. It's actually more the underlying performance of the earnings, I think.
So Martin, the 200 today went and briefly touched the lowest level since late June.
Yeah.
Towards the end of the trading range that we've seen over the past few months, is this an opportunity to go and buy?
Yeah, it's we've got a couple of little red flashing lights in our office. Maybe green flashing lights is a better analogy. Green flashing lights. When the total shareholder return of the ASX 100 reaches 15%, that's traditionally been a good time to start looking at equities and start adding them to your portfolio. And I'm not saying necessarily go and mortgage your house and buy equities. It's more about asset allocation. It's about saying at this level, the risk reward looks really attractive for equities. So that chart there, the black line is the fair value, and that's calculated from every analyst target prices on all the 100 companies. And we got that back for about 15 years or so. So that's a value bottom-up valuation of the market. The grey line is 15%. So what level of the market do you buy to get a 15%, assuming you achieve that black line in a year and you get the dividends? And the orange line is actually the market yourself. And you can see that it was overbought back in January. You could have probably sold the market back then and done quite well. Massively oversold in March. And it's bounced around fair value recently. But you see that black line's heading up, which means analysts are revising up target prices, and yet share prices are going lower. So it's hit that, it's 15.4 as we speak. So on a pure asset allocation basis, you're putting money into equities.
KFC has been a big one. Collins Food, obviously representing KFC. What's your take on this one? And is this all being driven by KFC in terms of the performance of Collins Food? People wanting that in lockdown.
It's not one that I've looked at for a while, and it's not one that we cover at Shaw. This is probably just something that's popped up today. I was looking through the best and worst performers, and Collins Food was up towards the top. I think it was up 4% today. And it's like, I just had a bit of a closer look at this, and this company's been performing super well through COVID. A lot of countries have been closing stores, like in the UK they've been closing stores, but these guys have been trading really, really well. And why is that? It's contactless, right? So you can go and get your KFC, you can get it delivered to your home, you can do drive-through, you can do click and collect, and people are really adapting to that. So fast food as a category is performing super well in this environment. They're also rolling out Taco Bell, which is the Mexican food chain. It's massive in the States. And Yum Brands owns that as well as KFC.
Cheap and cheerful too, right?
Yeah, so people like that. And they're also got KFC in Europe as well. So that does seem to have a bit of a growth story beyond just the coronavirus. So that's an interesting stock.
Martin, can I ask you, we've had so many guests on lately that have been talking about the recovery story and wanting to get into that. Now that we're seeing a silver lining coming out of Victoria, but then on the flip side, you've got what's going on in Europe at the moment. And it's taking a turn for the worse. We're likely to see more lockdowns, restrictions. Just puts the, focus back on us saying, well, are we going to see more lockdowns from here?
Yeah.
How much uncertainty is ahead? Is there, a right to pause at the moment and say, look, maybe avoid the travel stocks, maybe avoid some of these recovery story stocks right now?
I think you've got to have some in there, Ingrid, and the reason is not necessarily the path of the coronavirus. It's more around the vaccine. So we've got 9 drugs in FDA phase 3 trials at the moment, and we might get data on a couple of them at the end of this month / start of next month. So Moderna and Pfizer, the CEOs have both come out and said, we will know and we will have data by the end of this month. So you kind of got to run that through. Okay, what if it comes out and it's great, it really works, it's got high efficacy, what are the markets going to do? They're going to pop. And what are people going to buy? Qantas, Flight Centre,
Yep.
Sydney airports. So you've got to have them in there. You don't load up. Think of it as a tail risk. So think of gold for the downside. If things go really bad, you want to own gold because it's going to do well.
Yeah.
And if things go really, really well, you want to have some travel exposure. So I don't say you avoid them, but if you've got too much of it, you might want to think about that. But I think it's definitely worth having some in there.
I was just thinking this morning when I woke up, the first thing I was like, well, looking at the sell-off, and I was like, geez, only last week we were talking about vaccines and all the optimism, and obviously that's been thrown out the window very quickly. Martin, so stocks are now in the buy zone. You've given us some great tips out there at the moment, some travel names as well, some energy. Anything else caught your eye where you think, well, maybe there's still a bit of value creeping in after the recent pullback?
Yeah, look, I've been long and wrong on one stock, which is Treasury Wine Estates. So that they actually, very concerned about the CEO leaving, change of strategy, spinning off Penfolds, new manager coming in, which the market didn't, know as well as the previous one. And then the result came out and it was a cracker. The stock was up 20%. Everyone loved the numbers. And then China came out with this anti-dumping thing, which most people in the wine industry scratch their heads and go, how can you dump premium wine? It's just not possible, right? So you kind of look at that and go, the stock's below $9, I think. So it was 20 a year ago. So I think that's a stock that it's not really a macro story. It's more of a micro, what's going on in the wine industry, what's going on with trade and China. So I think there's a positive resolution sees that stock significantly higher than what it is. And it's got to be a really serious anti-dumping thing against Australia to stop people buying wine there. So I think that's one that's been caught up in the negative sentiment in the market, and that's one that could look interesting. Having said that, I'm probably long, double the share price, so I've been wrong so far.
The UBS note that came out yesterday, I think, talking about $63 billion of travel money that's not going to international travel, that Australians spend on international travel, going elsewhere in the economy. Do you see this going to discretionary, the excess money that's not going to, trips to Aspen or Europe if you're lucky enough to go there? Where is that money going? And are you looking at that trade?
It's going in the bank at the moment, right? So saving rates in every country are through the roof. It's 18% or something in Australia. It's crazy. So it's going to get spent. It's interesting. I got an offer today from Qantas to take a 7-hour flight, sightseeing flight for $800. Right? So I'm missing air travel so much. I'm going to fly on a plane that doesn't go nowhere, but I get Neil Perry giving me lunch. Right? So I think
in a confined space.
And as we come into the holiday season, what are people going to spend their money on? So I think we're going to have as you said, there's a lot of disposable income there that hasn't been spent. It's not going to travel. It's in Sydney at least you can go to a restaurant. In Melbourne you can't even do that. So there will be definitely a kick up in that sort of discretionary spending.
Well, we'll be able to go and fly to Adelaide soon, so Fraser McLeod better go watch out. He's going to go and the Sydney siders are coming, so looking forward to going getting over there at some point. Martin, just from a holistic perspective, you're looking at what's going on overseas in the United States and Europe last night. Putting aside the concerns about the virus, when it comes to what's happening with the fiscal side of things in the United States, heading into the election as well, how concerning is that from an investor perspective, given the influence that Wall Street has over the rest of the world?
Yeah, it's massive. So the big uncertainty here is the election, and you've had lots of people on there talking about that election, and you'll have a lots more in the next 40 or so days. There are some strategy groups in the US that are putting out a Trump portfolio and a Biden portfolio, and you can tell which one's doing better depending on who's going to win. But there are quite different policies around things like healthcare and infrastructure and the new economy and that sort of stuff. So I think that remains a risk, and I think investors need to be very wary of that. I mean, the flip side to that is that interest rates are super low, governments are backstopping the economy. The financial risk is really not that significant, not like I was in the GFC. So I think it is a good time to be owning equities, but you just got to be aware that there are these macro risks out there which you can't control. And reality is, it doesn't matter what the polls say anymore, does it? You used to be able to rely on polls. You can't even do that. You can't rely on bookmakers. So and most Americans make up their mind on who to vote for on the day. So this thing could go either way. So people just need to be cognizant of that.
Your view, NAB's come out and changed their policy view today after DeBell's speech this morning, talking about a significant risk to cut the cash rate, 3-year yield target TFF to 10 basis points, so a 15 basis point cut. The question here is, would this have any impact on equity markets in your view? If we do see another cut from the RBA to interest rates even lower from where they are now, does that make a difference to equities?
It's a tricky one because no one's using the long-term bond rate in their valuation models. No one's using less than 1%. So you kind of got. Most analysts are still using either 3 or 5, which is seems kind of ludicrous, depending on where rates are now. So even if the RBA moves to 0.1 or to negative rates, as some people are saying, Is that going to change the valuation outlook? Probably not. So the question then becomes, why is the Reserve Bank doing that? They've got to think. So things are improving. We had a much better employment number than everyone thought. It was 1% better. It's 6.8. It's coming down. So why would they want to cut rates further? They'd have to see something they're really worried about. So they'd have to get a sense that Canberra's not proceeding with the stimulus, and so therefore they're going to have to step in and do that job. So that would be a real concern for equity. So I think if the Reserve Bank was cutting rates, you'd be worried. Yeah.
I think they're going to do it. So I'm just reading the NAB's note here. It's similar to what I was writing last night in one of my notes, but doesn't mean that's actually going to come true. But interesting to see the NAB, the first of the big four, who are now signaling that they think there's going to be additional work for the RBA to be done in the not too distant future. Martin Crabb from Shaw & Partners, always fantastic to get your views on a Tuesday afternoon.
Great to be here.
Enjoy the rest of your week.
Thank you.